Hey guys, what's up? I'm Erin and welcome back to the channel. Let's talk annuities. You often might hear a narrative that annuities are always a bad deal, but is that true? Today, I want to break down the pros and the cons so you can form your own opinion, because here's the truth. Annuities are absolutely not a fit for everyone. But for some people, in the right situation, with the right type of annuity, they can be a valuable retirement planning tool. At their core, annuities are simply insurance contracts. You hand over a lump sum or sometimes a series of payments to an insurance company who in turn either promises to grow this money with a certain guarantee or provide you a steady stream of income, often for life. They're built on something called mortality credits. In plain English, that means your payments, combined with the pooled resources of other annuity holders, allow the insurer to provide income that could last longer than your own assets might on their own. Annuities also come with different payout options. You can choose life-only income, which stops when you pass away. You can select a period certain option where income is guaranteed for at least 10 or 20 years. You can opt for joint and survivor payouts, which continue for the life of both spouses, or refund provisions that ensure your heirs receive something back if you pass away early. The important trade-off here is this: the more guarantees you add, the lower your monthly payout will be. And here's a key point to remember. Insurance companies are businesses, and they're exceptionally good at making money. So when they sell you a guarantee, that means they're going to take your money and invest it in a way where they think they're going to make a higher rate of return, and they're going to keep the difference. That's how they make money. That means the payout is intentionally set lower than what the insurer believes that they can receive over time. And this built-in profitability is one of the main reasons annuities often carry such a negative reputation, especially among those who prefer to be DIY investors, invest for themselves, and then keep this margin for themselves. And not all annuities are created equal. Let's walk through the main categories. Immediate income annuities, SPIAs. You give the insurer a lump sum and they start paying you an income right away. Think of it like buying yourself a pension. You know exactly what you're going to get. The downside here is a lack of liquidity and often a lack of inflation protection, because with most annuities, you buy a specified monthly payout and generally it is not inflation adjusted. So the purchasing power of that payout tends to erode over time. But as far as a bang for your buck perspective, these are the cleanest type of annuities to buy. Deferred income annuities, DIAs or QLACs. This is a very similar concept, but the income tends to start later in life. So you might buy one earlier, say at the age of 65 or 70, and the income might not start until 80 or 85. QLACs are a special type that you can buy within an IRA or a 401k, and they can help to reduce your RMDs or your required minimum distributions when that time comes. Next, we have fixed annuities and MYGAs. These act a lot like CDs. You get a fixed rate of return guaranteed by the insurer for a set number of years. Recent MYGA rates have ranged from about 5% to just under 7% depending on the term. The shorter the guaranteed term, the higher the rate. The longer the guaranteed term, the lower the rate. These three annuity types we could rank as the best annuity types. The most straightforward, the most transparent in their pricing. You're going to get the most bang for your buck out of these types. But let's continue. Fixed indexed annuities, FIAs. These tie your returns to an index like the S&P 500. But here's the thing to know: there are caps in place and participation rates. For instance, let's say the S&P 500 returns 10%, but your cap in your contract is 6%. Well, at that point, you would only capture 6% of that return. The insurer keeps the difference. These products allow you to have growth potential, but often there's a limit on the amount of growth you can capture. They also have downside protection, saying that maybe you don't get any downside or you're limited in your exposure to the downside of the market. But the complexity of the caps and the participation rates and the renewal terms mean you really have to read the fine print here. On average, the expected return is lower than what you might capture if you were to simply invest directly in the market yourself, but generally higher than a plain fixed annuity. Some people value this trade-off, others don't. RILAs, Registered Indexed Linked Annuities. These are a newer hybrid annuity, and again, they are tied to an index like maybe the S&P 500. They allow you to be exposed to more of the downside if the market performs poorly, but the trade-off is that you can capture more of the upside when the market performs well. They can offer you more upside than fixed indexed annuities because they allow you to be exposed to more of the downside. But they're also relatively complex, and generally speaking, the more complex something is, the better it is to stay away from it because it's not consumer friendly. So those next two we'll put in the middle category. We're adding a lot of complexities, we're adding a lot of fine print, and the more you do this, the more you're stacking the deck against you. Finally, we have variable annuities, VAs. These invest directly in mutual fund-like accounts. They give you market exposure, but often come with very high fees. So if you had an ick vibe when you heard me say the word annuity, it's because of this type. This is the type that often gives annuities a bad reputation. Fees of 2 or 3+% per year are common, and once you add in riders, it can be even higher. Over the decades, those fees can eat up a huge portion of returns. They're also very complex, so it makes it very difficult for buyers to fully understand what they're getting. So unless you have a very specific niche case that would require this, just steer clear. We will go ahead and put variable annuities in the category of worst annuities. I don't like to make blanket statements, but in general, just steer clear. So why would somebody want an annuity? Why might it make sense? First, longevity protection. Annuities provide a guaranteed income for life, and that protects against the risk of outliving your money, or what economists call longevity risk. And this fear of running out of money, this is the #1 fear among retirees. So for somebody who is incredibly conservative and incredibly worried about running out of money, having a guaranteed stream of income, knowing that you can meet your expenses for the rest of your life, can bring a great sense of peace of mind. Second, behavioral benefits. People with guaranteed income, whether that is from Social Security, a pension, or an annuity, often spend more confidently in retirement because they know their essentials are covered. Research published in the journal Financial Planning found that retirees with a higher share of guaranteed income reported about 30% greater satisfaction and confidence in their spending compared to those relying most on investment accounts. And broader studies back this up. Retirees spend roughly 80% of their lifetime income, aka guaranteed income streams, but less than half of their invested capital. And every dollar of assets converted into guaranteed income results in about twice the spending compared to leaving it invested. In other words, a steady paycheck doesn't just cover expenses. For many retirees, it gives them a license to spend. It really gives them permission to go ahead and enjoy their money, whether that is for travel, hobbies, leisure, you name it. And honestly, isn't that what our money is for? To be enjoyed? We spend a lifetime saving. Once we get to retirement, we really should be giving ourselves permission to spend. Third, market protection. Fixed and index annuities can limit your downside risk, and for conservative investors, this can give them a great peace of mind. And that really matters. In fact, 80% of retirees report being worried that a market crash could meaningfully erode their nest egg. And finally, for those without a pension, an annuity really can give you this sense that you have a retirement paycheck. Let's do an example. Suppose you're 67 years old and you put $250,000 into a single premium immediate annuity today. Depending on your state, your gender, and whether it's joint or single life, you might get anywhere from $1,400 to $1,600 a month for life. Let's say you lock in $1,600 a month. If you only live to the age of 75, that's about $153,600 total back on a $250,000 investment. That's not a great deal. You would have been better off leaving this money invested and steadily drawing on it. But let's flip the scenario. If you live to the age of 100, those monthly checks add up to nearly $634,000 in lifetime payments, more than double your original investment. And you achieved that without worrying about market risk, without worrying how to draw down your portfolio in a safe manner, without worrying about outliving your portfolio. So that's the big trade-off with annuities. They don't look great if you pass away early, but the longer you live, the more valuable they can become. Annuities get a lot of criticism, and many of those criticisms are valid. So why do people say they're a bad deal? First and foremost, very high fees. Variable annuities are going to be our poster child here. They might have expense ratios that exceed 1%. The mutual fund accounts themselves that they invested would have expenses that often exceed 1%. Then if you add any riders, they might add another 1%. So you can easily have fees that exceed 3% on an annual basis. Over 10 or 20 years, that kind of drag is absolutely massive. Having a 3% annual fee can take away half of a portfolio's growth over a 20-year period if you compare that to directly investing in low-cost investments. Now, to be fair, the cleanest types of annuities don't look like this at all. If we were to talk about an immediate income annuity or a deferred income annuity, they're going to have a one-time upfront commission ranging anywhere from 1% to 5%. So it doesn't mean that it's cheap, but they might not have any ongoing management fees. Fixed annuities often advertise no explicit annual fees at all, but the trade-off is liquidity. You'll pay with surrender penalties or market value adjustments if you need out early. So the cost is there, but it's baked into the payout rather than being charged as a single line item every single year. And this is where annuities get their bad reputation. Fees and trade-offs are buried in the finest of fine print, and insurance companies know how to make these costs hard to spot. Anytime something is deliberately hidden, it causes our guard to go up, and we think, why can't you just be straight with me? And honestly, I don't think annuities would have such a bad reputation if insurance companies were just upfront about it. If they said something like, hey, you're uncomfortable with risk once your paycheck stops. We'll absorb some of that risk, but it's going to cost you. We're going to charge 3%. Take it or leave it. That's the price of a guarantee. Now, we may not like it, especially those among us who are DIY investors and we want to maximize every single dollar, but at least it would feel honest. The real problem isn't only the cost itself, but it's the way the industry tends to hide it in the fine print. And that's why so many people have that ick vibe when we talk about annuities. Second, complexity. Many of these products are packed with opaque terms like caps and spreads and participation rates, so much so that even financial professionals struggle to fully explain them. And this is really where it comes back to trust. When a product is so complex that even a professional can't give you a simple, straight answer, it's why investors can feel uneasy. Third, a lack of inflation protection. Unless you buy a costly inflation rider, your payout stays fixed over time while the cost of everything around you tends to increase, and that erosion is real. Let's take a $1,500 monthly payout as an example. After 10 years, at a 3% rate of inflation, it might only feel like $1,100. After 20 years, you would have the spending power of $830. After 30 years, that same $1,500 check might have the buying power of just over $600. So without inflation protection, what feels comfortable today can shrink dramatically over time. Fourth, insurer risk. Your income guarantee or your annuity is only as strong as the company that's backing it. While state guarantee associations provide a safety net, coverage limits vary by state, often around $250,000 per owner per insurer. Even with those protections, if your annuity is above the limit and your insurer fails, you may not get back everything you would expect. This is why insurer strength should be a non-negotiable if you're considering an annuity. You don't want to trust your retirement to a smaller, weaker company. If you're going with an annuity, make sure you go with among the largest, most financially secure, highly rated insurers, the ones who have the capital reserves to back up their promises. And finally, these products are profitable for insurers. Annuities are designed to make money for the company that is offering them. That doesn't automatically make them bad, but it does mean that the deck isn't totally stacked in your favor. If you're considering buying an annuity, you need to approach it with clear eyes. You're buying a guarantee, and that guarantee comes with a cost. The key is to fully understand that cost, and then you can decide if it's a price you're worth paying for peace of mind. Let's do an example. If you invested $250,000 into a balanced 60-40 portfolio and withdrew 4% a year, about $10,000, and captured a 5% real rate of return after 20 years, you'd still have roughly $333,000 left in your portfolio. That's money on top of the already $200,000 you've already taken out in income. You also have flexibility. You can increase or decrease your withdrawals based on market conditions. With an annuity, you don't have that same flexibility. Once you lock in your fixed payout, that's the payout you get. And unless you pay for an additional survivor benefit, once you pass away, the money remaining in the annuity is gone. But here's the flip side. That same $250,000, if used to purchase an immediate income annuity at age 67, could give you around $1,600 a month, or about $19,200 a year, guaranteed for life. Compare that to the 4% rule on a portfolio, which only gives you about $833 a month. The annuity offers nearly double the paycheck right out of the gate. And it does so without forcing you to take an aggressive withdrawal or worry about market swings. So if we break it down in a nutshell, it's essentially flexibility and legacy versus a guaranteed income you can't outlive. One of the most overlooked downsides of annuities is liquidity. Many deferred annuities have surrender penalties that last maybe 7 or 10 years. In the first year, if you were to pull that money out, you might face a 7% penalty, and that penalty does decline over time. To put that in perspective, if you invested a $250,000 lump sum, a 7% penalty in year 1 would cost you $17,500 just to get back your own money. So only annuitize what you truly don't need access to. You don't want to lock this money up in an annuity only to say 2 years later realize you need it back. Some contracts do include exceptions. For example, certain annuities waive surrender charges if the owner enters a nursing home or a memory care facility. My father purchased an annuity, and not long after, he was diagnosed with vascular dementia and had to enter a memory care facility. Luckily, his annuity had such a waiver, but when I brought this up with the sales agent, he tried to deny that that clause existed. Fortunately, I had insisted on doing a recorded call at the time that this contract was signed, and that documentation proved invaluable for making sure that this waiver was honored. What made this situation even worse is that my dad's memory issues were already apparent at the time when he was buying this annuity. He just hadn't yet received a formal diagnosis, so he was in a vulnerable position. So at the time, my father still had full control of his finances. In my view, he should have never been allowed to sign this contract, and I brought this up with the salesperson who let his eagerness to make the sale outweigh a better judgment that he should have exercised. This experience for me really drove home how important it is that you protect yourself, that you protect your loved ones when you know they're vulnerable. Demand transparency and read the fine print. Another wrinkle is something called market value adjustment. This means your payout can depend on where interest rates are when you withdraw early. For retirees who value flexibility, this type of clause can be a real problem, especially when you compare that to, say, a traditional brokerage account where you can sell anything at any time without any penalty or hidden cost. Let's talk briefly about taxes, because annuities come with some unique rules. First, tax deferral. Any growth within an annuity isn't taxed until the money is taken out. So think of it as similar to a traditional 401k or a traditional IRA. But once that money comes out, it is taxed as ordinary income. You aren't subject to long-term capital gains rates, which are more favorable. Second, the exclusion ratio. If you buy an annuity with after-tax dollars, what's called a non-qualified annuity, each payment you get back is split into two pieces. One part is considered a return of your original principal, so it's not taxable, and the other part is taxable income. The insurance company calculates this mix based on what's called the exclusion ratio. And over time, as you get more and more of your principal back, more of your payout becomes taxable. Third, RMDs. If you hold an annuity within an IRA or a 401k, it's treated like any other traditional retirement account and it's subject to RMDs, currently 73 and set to go to 75 by 2033. One exception here is the QLAC, the Qualified Longevity Annuity Contract. QLACs let you move a portion up to $210,000, and that number is indexed, a portion of your retirement account into an annuity and delay those RMDs all the way out to the age of 85. So the bottom line, annuities offer tax deferral, but you want to understand how the payouts or the withdrawals are taxed and make sure it fits within your retirement income strategy. And if they're being used alongside a traditional IRA or 401k, make sure you understand how it fits there. So are annuities good or bad? Well, the truth is somewhere in between. As with everything on my channel, my goal isn't to push you one way or another. It's to lay out the options so that you can make an informed decision for your situation. I'm not pro-annuity, I'm not anti-annuity. What I am is pro-options. Annuities aren't some scam that some critics claim they are, and they aren't a magic bullet that solve every problem as you go into retirement. What they are is a tool, and that tool comes with a price tag. Used wisely, it can provide stability and peace of mind, but used carelessly, it can erode your wealth and tie your hands. And it's not an all or nothing decision. Maybe you look at your retirement income profile and you look at Social Security as the base, but maybe you want a little bit more of a guarantee. So maybe you decide to annuitize a portion of your portfolio and leave another portion invested and growing and accessible whenever you need. So in this situation, that could be a wise decision. Here are a few brief guidelines if you're considering an annuity. Who might it be a good fit for? Perhaps people without a pension, perhaps people who value guaranteed income streams, for those who are risk averse and don't want to face market volatility head on, for those who want to make sure and have a guarantee that their essential expenses are covered. Who might an annuity be a poor fit for? Those who want full control and access to their money. They want liquidity. Those who want maximum growth within their portfolio. Those who want to leave a strong portfolio behind to their heirs. Also, those who haven't taken the time to fully understand the product that is being pitched to them. So here's a checklist. Look at the fees, the surrender periods, and renewal terms. Check the insurer's financial strength. The ratings from AM Best, Moody's, or S&P matter. Before you commit to an annuity, here are some strong alternatives worth considering. Number 1, delay Social Security. Every year you wait past full retirement age, your benefit grows about 8% until age 70. It's government-backed, inflation-adjusted, and risk-free. It's one of the best annuities out there. Build a bond ladder. Buy a series of bonds or CDs that mature at different times. This gives you predictable income, but it still gives you control and access to the principal. A TIPS ladder. Treasury inflation-protected securities. This provides guaranteed inflation-protected income guaranteed by the U.S. government, and you can line it up with your retirement spending. Systemic withdrawal plan. Keep your portfolio invested and withdraw at a sustainable rate, say 3.5% to 5% a year. Here you get flexibility, growth potential, and the chance to leave a legacy. You get control over your money, but you are still exposed to market risk. Some people find that they can have great peace of mind if they schedule a regular paycheck coming from their investments through their brokerage house and landing into their checking account every single month. So it depends on what your comfort level is. Target date or managed payout funds. These are funds built to gradually spend down assets while aiming for stability. They're simpler and more flexible than annuities, but they're not guaranteed. Cash value life insurance. Some policies can provide supplemental retirement income through loans or withdrawals. Now, these cash value life insurance policies are incredibly complex. They come with high fees, and they are often pitched as an alternative to an annuity, but know that these are one of those financial products that are going to come with high fees, and your money is likely better invested elsewhere. When I talk about life insurance on this channel, I'm a big fan of term life insurance, but if you already have a policy, this could be an option. And finally, a bucket strategy. This is where you split your portfolio into a short-term bucket, which would be cash and your immediate term needs, a mid-term bucket, and then a long-term bucket that captures growth. Here you have all bases covered. You know your near-term spending is covered. Should something happen with the market and there's a downturn, you have cash readily available, and you also are capturing growth, so the future you is able to keep your spending steady. I do have an entire video dedicated to the bucket strategy, and I'll link it above and down below if you're interested. The takeaway is that annuities are just one tool in the retirement toolbox, so you want to heavily consider any alternatives before you lock up a sizable portion of your portfolio. And as with any retirement plan, it doesn't have to be all or nothing. You can blend many of these strategies to build your ideal retirement. Let's do a quick fire round of myths versus facts about annuities. Myth number 1, annuities are always a scam. The truth is, some annuities deserve this criticism. They have high complexity and high fees. But the truth is also that not all annuities are created equal. Some income annuities, like immediate annuities or deferred annuities, can be quite clean and transparent, and in the right situation, cost-effective. Myth number 2, if I die early, the insurance company keeps all of my money. This can be true if you select a life-only payout, but many contracts come with period certain provisions, so they pay for a certain period of time, or refund provisions that ensure that your heirs get something back if you pass away too soon. Myth number 3, all annuities lock up your money forever. Many deferred annuities do have lockup periods, maybe 7, maybe 10 years, but not all annuities are like that. Many immediate income annuities or fixed annuities don't lock up your money like that, so the key is to know what type you're buying. Myth number 4, annuities always give you terrible returns. Again, this really depends. If you're looking at a variable annuity and you factor in their incredibly high fees, yes, those do underperform. But fixed annuities today are offering guaranteed rates of, say, 4.5%, 5%, or even 6.5%, depending on your term length, and that can be comparable to the CD market. Myth number 5, annuities are tax-free. Annuities are tax-deferred, they're not tax-free. When the money's in the annuity, it grows completely tax-free, but once you start to take payouts or withdrawals, that money is taxed as ordinary income. Some people find this helpful, other people don't appreciate this. Myth number 6, annuities automatically protect against inflation. The truth is, most don't unless you buy a costly inflation rider. So if your payout starts at, say, $1,600 a month, in 20 years' time, while you still will be receiving $1,600 a month, it might only feel like $800 or $900 in terms of spending power. So if you want to add an inflation rider, you can, but it comes at a cost. Myth number 7, the insurer's financial strength doesn't matter because states backstop annuities. The truth is, state guarantee associations do provide a safety net, but coverage usually caps around $250,000 per owner per insurer. Your guarantee is only as strong as the company that's giving it, so make sure to look at the financial ratings of the insurance company. Myth number 8, once you buy, you're stuck for life. The truth is, liquidity is limited, but some policies do offer partial withdrawals or are willing to waive surrender charges if the owner of the annuity enters a memory care or a nursing facility or has a diagnosis of a terminal illness. But the reality is, you don't want to try and count on one of these exceptions, even if they do exist. Myth number 9, annuities are only for the ultra-conservative. Now, they are designed with conservative investors in mind, but some balanced planners may use them strategically. Perhaps a balanced planner uses an annuity to cover their essential expenses, knowing that this is a guaranteed income stream, and then that gives them permission to invest more aggressively with the remainder of their portfolio. Myth number 10, annuities are only for people in their 70s or 80s. The fact is, while annuities are more common later in life, they can be utilized by pre-retirees. Maybe a pre-retiree uses a delayed income annuity or a QLAC to manage future RMDs. So they're not just for people who are already retired or perhaps in their later years of retirement. So at the end of the day, annuities aren't villains and they aren't miracle workers. They're simply tools. For some retirees, that guaranteed paycheck can mean peace of mind. For others, the loss of flexibility and hidden costs makes them a poor fit. The key isn't whether annuities are good or bad, it's whether they're right for you. And to answer that question, you have to look at your entire retirement portfolio and your entire set of retirement income streams. Look at your savings, look at your investments, look at your Social Security, and then ask yourself, what do you need in terms of guarantees? What do you need in terms of flexibility? What do you expect in terms of growth? What do you need to build so you can spend in a way so you can sleep soundly at night? And I'd love to hear from you. Do you own an annuity? Do you love annuities? Do you hate annuities? Are you completely neutral with them? Share your thoughts and your stories down below, because your story and your experience can help others with their decisions. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. These tie your return to a fixed index like the S&P 500. But here's the thing to note. There are caps in place and I don't know. What is up with the cars these days? My goodness. I'm gonna go put up a road blockade. The traffic. I live on the quietest of quiet streets and all day long today. Nonstop, could take away half of your portfolio returns over the course of this time. It's much worse. I'm trying not to say worse because it's comparative. We're trying. Sometimes I have to. I'm sorry. Sometimes, often, maybe. Let's do it. Okay, let's do it. You give the... I had a thought about directing traffic, but I'll just keep it to myself. You hand over a lump sum or sometimes a series of payments to an insurance company who in turn sometimes... There's a lot of sometimes in the sentence. Sometimes I'm not getting it. Nailed it on the 47th take.